Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Today, we're talking about investing in technology with the private equity investment company sector. Both short and long-term returns from private equity investment companies have been strong, with the average investment company in the private equity sector returning 30% over the past 6 months and 210% over the last 10 years. The performance of listed tech stocks has never been far from the headlines during the pandemic. But how are private equity managers investing in the unlisted technology space? And what is their outlook for the sector? To discuss this, I'm delighted to be joined by Stephen Tredget, partner of Oakley Capital, the manager of Oakley Capital Investments, David Toms, director of research at HG, the manager at HgCapital Trust, and Paul Daggett, manager of MB Private Equity Partners. Right, on to the questions. And David, what are the most exciting areas of technology investment and how are you getting exposure to them?
Thanks, Annabelle. It's interesting because when people talk about exciting technology, they often think about self-driving cars and things like that. But actually for us, the most exciting areas of technology are the dull business processes that companies don't want to have to spend too much time on, where we can automate those and free up the time for productive business activity. So things like tax and accounting software, payroll, ERP, we've been heavily invested in that space for a long time. And by doing that, we're allowing businesses a lot more time to get involved in things that can add significant value to their end customers. So we are invested, for example, in Visma, which is one of the largest tax and accounting software companies in Europe. And in fact, were that listed in the UK, it would be a FTSE 100 company. That kind of stuff to us actually is very exciting.
Excellent. So it might not be that exciting, but actually companies really need that sort of technology, don't they? Great. On to Stephen. Stephen, what are the most exciting areas of technology investment you're investing in? How are you getting exposure to them?
Hey, Annabelle. Yeah, thanks. We focus on digital tools and platforms, and these are tools and platforms that are becoming increasingly popular B2C and B2B solutions across a multiple of sectors. I mean, solutions that are enabling online direct-to-customer interaction, whether in education or digital consumerism or business services. And we particularly specialize in backing leading digital participants in either traditionally less digitized parts of the economy or in geographies where adoption of digital infrastructure or e-commerce or cloud migration has lagged more mature markets like the UK and US. And to give you some brief examples, we are an investor in the largest and fastest growing private university group in Germany, which delivers its higher education almost exclusively online. Or we've backed the market-leading price comparison website in Italy, which is Factually.
Well, online education, I have plenty of experience of that as I have 2 children, and it's been quite an experience, I can tell you. Paul, on to you. What are the most exciting areas of technology investment? How are you getting exposure to them?
Yeah, so I think the first thing to clarify is, of course, it depends whether we already own them or we're talking about new investments, because obviously prices adjust for the most exciting areas. I think within MBP's portfolio, the areas that we've seen the most dramatic change and growth is areas where the original investment thesis has been accelerated by the pandemic, and online retail is one such area. A couple of quick examples within PetSmart Chewy. Chewy is an online retailer of pet supplies in the US. Not surprisingly, that has seen very good results and very good stock price performance during the pandemic. Another example would be MHS, which is a company that provides services to distributors of packages. So again, the underlying thesis there is around online retail, and that thesis has been very much validated by so I think those 2 examples are interesting because obviously we're not a tech-only portfolio, and those 2 examples come from retail and from industrials within our underlying portfolio.
Right. Now, going on to the crisis, how has your company navigated the COVID-19 crisis, and what's been the impact on your portfolio? And I'm going to ask that to Stephen.
Yeah, yes. Well, I mean, look, I think I'm going to use the overused, one of the many overused words of 2020 and talk about our resilience. And why we've had that resilience is because, as the topic of this conversation implies, you know, a decent percentage, 3/4 of the Oakley Capital portfolio delivers its products or services digitally. And as a result of that, they're either in a robust position already, they've not had to close down a physical network as a result of lockdowns this year, or if they had a physical operation, they were able to switch. Or if they were a digitally native business, then they've really potentially seen an acceleration of the adoption of their service. That said, you know, the pandemic has caused disruption in lots of ways, even in, you know, successfully operating businesses that haven't had to close down. For example, if you're a software business, you know, your sales effort this year may have been hampered by the fact that you may have had mixed communication with your potential customer base. And in some cases, let's say price comparison, you know, people have been less inclined at the moment, or maybe didn't even need to reinsure their car or take on a personal loan, etc. However, the gain in market share has been big. So overall, we've seen a reasonably robust performance. I think over the course of the year, you'll see our average EBITDA growth come down in comparison. A typical year, EBITDA growth for us has been 25-30% EBITDA growth. Well, at the half year, the full year average was about 17.5%. So you can see that there has been an impact, but more importantly, the profits of these businesses is still growing despite current events.
Well, robust sounds good. Paul, what's been the impact of the crisis on your company and your portfolio so far?
Yeah, so fortunately, MBP's portfolio had really been positioned to non-cyclical, or at least relatively non-cyclical sectors and companies, or companies where we felt there was a secular long-term growth driver. And we've done that over the last 2 or 3 years, expecting a downturn at some point, obviously not expecting a pandemic. But that has meant that the results of the company have been good. If you look at the last 12 months to June the 30th, we saw revenue and EBITDA growth across the portfolio in the 80% of companies where we report that in aggregate. So again, the performance has been good. I think the other thing I would say is that liquidity in the portfolio has been very strong. And actually, we've had about $140 million of realizations within the portfolio over the first 10 months of the year, which is about 13% of our beginning of year portfolio value. And so again, as much as realizations are an indication of health, then we're pleased to see that as well.
Well, that's good news on the realizations. David, how has the crisis impacted your company and portfolio?
Hi, Annabelle. Yeah, I mean, as I'm sure people are aware, we focus entirely on software and services, and that's an industry which is well known to have had a very robust performance through this period. So from an industry perspective, we've been fine. Portfolio trading has been fine. The challenge of this crisis has been very much the human side of it. It's how you deal with moving people to a working from home environment, how people deal with health issues, because some people are affected by COVID. So the whole human side of the crisis actually has probably been the greatest challenge for everybody, for society as a whole, as well as for our businesses. And we're pleased to have helped our companies work through that. But from an industry perspective, there's really been very few challenges for software.
Well, that's good. And I think the human side of the crisis is something we've all felt an impact on, and we've all had to work through. Moving on, Paul. Now, I have to say, Paul is joining us from Dallas today. Paul, how does tech compare to other sectors, and where else are you seeing opportunities?
Yes, so our model is to co-invest alongside general partners around the world, you know, in their areas of specialization. So we do look at all sectors, and you know, I think we fortunately have seen really good performance across sectors. And so as you think about retail or industrials, you might think those sectors as a whole could be a concern, but within MBP's portfolio, we saw revenue growth and EBITDA growth across those sectors in, again, the last 12 months to June the 30th. And so I think we certainly like technology and like the secular growth and certain other characteristics that you see in software investments. But we are seeing opportunities across retail, across industrials, and across business services and other areas within our portfolio continue to perform well. So again, I think diversification has proven to serve the portfolio well.
Yeah, you're seeing opportunities in a variety of sectors. Stephen, how about you? What other sectors are you seeing opportunities in?
I think the first thing to say is that we've talked a lot about technology or tech-enabled businesses. I mean, it's kind of unfair to stick them in a technology sector. I mean, the fact is, kind of technology-enabled businesses span multiple industries. And it's one of the sectors or the topic's kind of main attractions is that it can apply to, you know, whether it's for us, it's consumer tech companies or education tech companies, but it's basically technology across any sector that kind of deploy technology to create some kind of edge over a more, you know, kind of traditional competitor. And so I don't think we kind of feel ourselves kind of constrained to tech necessarily, and that actually you can take advantage of those trends across the multiple sectors. And of course, the much known thing this year is that the global pandemic has accelerated an already growing trend for traditional businesses needing to adapt and offer a digital or a tech-enabled service. So actually the opportunities across all sectors of the economy are quite extensive. And I think, you know, the kind of businesses we're looking for are those that, you know, are maybe taking advantage of some kind of shifting secular change. They're highly cash generative, they've probably got a sticky customer base, and they're benefiting from some kind of online platform.
Right. Now, why access technology through private equity exposure? What are investors in quoted equities missing out on? And I'd like to ask that question to David.
Thanks, Annabelle. I think there's two things they're missing out on. They're missing out on focus and they're missing out on timing as opportunities. And I'll actually take the second of those first, because what timing means is you're not having to time the market. So we have long-term committed capital in a close-ended fund, which we can use to make investments with a very, very long-term view. We can incentivize management appropriately for that long-term view. We can invest in businesses appropriately for that long-term view. So the ability to take that perspective on things and actually take away market timing is quite a significant upside for our sector. And then on the focus side, we have currently 34 businesses that do very similar things. So when we get all of our CTOs together to talk about cybersecurity issues in the space right now, they can bounce ideas off each other, they can leverage each other's experience. So the opportunity to compound returns across multiple investments is quite significant on an operational level as well as from an investment perspective.
Right. And Stephen, what do you think investors in quoted equities are missing out on?
Look, many technology companies, in fact, look, many companies full stop are remaining private for longer or are shunning the public market altogether. And you know that is a combination of lots of reasons. It's becoming less and less appealing to be a public company for a raft of reasons, and also more appealing to remain private, if not just simply because there's just a growing access to capital there probably wasn't 10, 20 years ago. And so in short, private equity funds are therefore the only avenue through which you can access some emerging sectors or company types. And it has often been the case that private equity has been early into a trend or a theme or a sector where there could be, it's yet to mature and reach the point where the public market is comfortable to back it. We're aware of the stats. There are a decreasing number of public equity companies and an increasing number of those backed by private equity. And that goes for whether or not they're technology driven or not. In fact, the bias is typically towards new economy type businesses and those that have taken advantage of technology or digitally enabled. And of course, it goes without saying that, of course, I'd be remiss if I didn't say that actually, if you invest in quoted equities, you don't have to miss out on this. We sit here as, with 3P firms who have, listed PE investment trusts that actually give you access to those underlying portfolio companies.
Great. And Paul, what are those investors in quoted equities missing out on?
Yeah, I mean, I would build on some of Stephen's points. First of all, I think active ownership and control is a key difference of private equity. And whether we're talking about business optimization or entering new markets or new strategies, or about M&A. There's a lot that a private equity fund can do with a long-term vision for a company, which would be very difficult to do if you have the quarterly earnings cycle of a public company. And so I think taking a private company with control, active ownership, and a longer-term viewpoint really lead to a different approach to investing. And then secondly, also building on one of the points Stephen made, companies in the market in private equity are of many different sizes. It could be small cap, it could be mid cap, it could be more growth, but you can access a smaller type of company, companies earlier in their growth cycle through private equity in general. And so I think those two things together really lead to quite a different universe of companies and of ways to generate returns than you'll see in the public markets.
Absolutely. Now we're coming to our conclusion here, and I'd like to ask Stephen, what is the outlook for your company and the private equity sector as a whole? It's been a very difficult year. What have we got coming up? Stephen.
Thanks, Annabelle. I think the first thing, I mean, look, private equity has been one of the best performing asset classes in recent decades, and I see no reason for that outperformance not to continue. Whether that's because of the bias towards certain sectors and certain sections of the economy in comparison maybe to the broader public markets. I also think that disruption creates opportunity, which private equity is in the luxurious position of being able to respond very quickly and maybe take advantage of that. And there are potentially going to be quite high quality assets that are available at attractive prices in the coming short period. To kind of to emphasize that point, there's some kind of Morgan Stanley data which shows that those vintage funds that are deployed kind of post the crisis or period of disruption tend to outperform and outperform significantly, nearly 68% premium compared to those before. So you're going to see the managers that sit before you deploying funds now into potentially once in a generation period of opportunity. So I think the outlook for the sector remains bright.
Well, that sounds great. Opportunities at a cost-effective price. Great. Moving on, Paul, what's your outlook for the company and the private equity sector as a whole?
Yeah, I mean, I think private equity can continue to outperform public equities over the longer term. Of course, asset selection and operational value add are becoming more and more important in private equity's ability to do that over time because more money is coming into the market. But I think with those two things and picking the best general partners and the best investments, then outperformance over the longer term is still possible. And I think if you look at the private markets, I think 2020 will be another strong market for capital formation. The fundraising does look like it'll be strong again. And that obviously is a vote of confidence from institutional investors in the asset class as a whole. I think for NBPE, we think we're well positioned. We're pleased with how the portfolio has held up during the pandemic. And we're also pleased that the private equity markets are so active again, and that we have a portfolio of assets which is maturing with about a 3.2-year average holding period. So hopefully, again, we can see that performance continue and exits over the short, medium, and long term.
Great, that you're getting confidence from the institutional investors. And of course, if you're a retail investor, direct investor, private equity investment companies might be one of the few areas where you can actually get access to these types of unquoted companies. Yeah. David, what's your outlook for HG and the private equity sector as a whole?
If you look at the sector as a whole and everything we've run through this afternoon, we've got growth in the investment opportunity generally, we've got growth in the private investment opportunity, and we've got growth in the end market. So we sit at the confluence of all three of those, which is a significantly increasing opportunity pool. And then layering onto it our own perspective as HG, we've been doing this for 20 years. So we started building our house a long time ago in this space. We're not someone who sort of rocked up a few years ago and thought it looked interesting. So layering on the opportunity with the experience we've got, we're really pretty upbeat, as you might imagine, about what the decades ahead have to come for us.
Yeah, let's hope it's going to be exciting, and let's hope performance is going to be good for shareholders. I'd very much like to thank our managers for joining us today. It's great to hear their views on private equity and technology, but I'd like to emphasize we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thanks so much for watching.